On July 4th, 2025, Congress passed new tax laws under what is now known as the One Big Beautiful Bill Act. This sweeping legislation introduces significant updates across the tax code, impacting how Americans file their taxes in 2025 and for the years to come. Here are some of the main changes you will see in 2025. First, current tax brackets extended. Our current and lower tax brackets were signed into law in 2017 as part of previous legislation. And if no action was taken, these tax brackets were set to expire. The Big Beautiful Bill made the current income tax brackets permanent going forward. Now, for planning purposes, this means that you can plan on using existing income tax brackets for 2025 and beyond. Next, there's an increased standard deduction. The bill makes the larger standard deduction created under the Tax Cuts and Jobs Act permanent. Additionally, the amounts for 2025 are slightly expanded. So for single or married filing separately, you're looking at $15,750 for standard deduction. Head of household gets $23,625, and married filing jointly or qualifying surviving spouse gets $31,500. Next, there's also an increased deduction for seniors, and this is effective 2025 through 2028. And the bill added an increased deduction for seniors. So that means taxpayers age 65 and older are eligible to take an additional $6,000 off of their taxable income. Now, there are phase outs and criteria that apply. It's going to start to decrease for taxpayers with a modified adjusted gross income over $75,000 for single filers and $150,000 for joint filers. It also requires a Social Security number valid for work, and it's not available to those using the married filing separately status. Another big change is going to be a SALT deduction cap bill increase. Now, this is going to be effective for 2025 through 2029. And the SALT tax, also known as the state and local tax deduction, provides a federal deduction for income and property taxes paid at the local and state level. Previously, this deduction had been capped at a maximum of $10,000 as part of the Tax Cuts and Jobs Act of 2017. So some new changes as part of this bill are the cap is raised to $40,000 for incomes under $500,000 or under $250,000 for married filing separately. Now, if your modified adjusted gross income is over $500,000, then the cap is gradually reduced by 30% until it reaches $10,000. And the cap and income threshold will increase 1% annually. Now, the increased cap to the SALT deduction may change whether it makes sense for you to itemize your deductions or claim the standard deduction when you go to file your taxes. You may want to reevaluate your situation with these changes, especially if you were heavily impacted by the SALT limit in prior years. Now, another big change is overtime pay received deduction. So basically no tax on overtime. This is going to be effective 2025 through 2028. And the new bill will allow certain workers to claim a dollar for dollar deduction for a designated amount of overtime pay covered by the Fair Labor Standards Act. Now, income eligible for the deduction is going to be capped at $12,500 for single, $25,000 for married filing jointly. Those with higher modified adjusted gross income may only be able to claim a partial deduction as the benefit begins to phase out starting at $150,000 single, $300,000 married filing jointly. Now, here's a key thing. The tax deduction is not available for people using married filing separately status. And additionally, the taxpayer receiving the overtime must have a valid Social Security number for work. It also requires employers to designate overtime wages on a taxpayer's Form W-2. A special rule in 2025 allows employers to approximate overtime. Next, kind of along those lines, we're going to see a tips received deduction, and so that's a no tax on tips. And that's effective 2025 through 2028. And the new tax law allows for a dollar for dollar deduction for a designated amount of tips earned by workers where tipping is customary. So income is eligible for the deduction is going to be capped at $25,000. Higher income workers may only be able to claim a partial deduction as the benefit begins to phase out starting at a modified adjusted gross income of $150,000 single, $300,000 married filing jointly. The deduction is not available for people using the married filing separately status. Additionally, the rules require the taxpayer receiving the tips to have a valid Social Security number for work and employer designation on a W-2 or similar form. Next, we have an increased child tax credit, and this is going to be effective 2025 and beyond. And the higher value of the child tax credit set by the Tax Cuts and Jobs Act is now permanent and slightly increased to $2,200 per child. Additionally, the amount of the child tax credit and related refundable credit of $1,400 will be adjusted for inflation annually. Now, the credit increased from $2,000 to $2,200 per child. Permanent phase-out thresholds are $200,000 single and $400,000 married filing jointly, and a Social Security number will be required for the taxpayer or at least one spouse for joint filers who is claiming the credit and for the child. Another interesting one is a car loan interest deduction. So that's a no tax on car loan interest. And this is going to be effective for 2025 through 2028. And it's really going to be impacting you if you're going to be buying a car soon. This is a new tax deduction that could possibly help your bottom line. If you're purchasing a new car and you're taking out a loan, the deduction may help lower your tax bill by allowing you to deduct your loan interest. Now, there's a couple caveats here. The deduction is limited to $10,000 of qualified interest. The vehicle must have a final assembly in the US. Vehicle identification number must be included on the tax return. And there's a phase out at 20% for modified adjusted gross income over $100,000 for single filers and $200,000 for those married filing jointly. Sticking with the vehicle trend here, clean vehicle credits are repealed. So those are going to be the EV tax credits. And this is effective September 30th, 2025. The bill permanently eliminates the following clean air vehicle credits for vehicles acquired after September 30th, 2025. That's going to be new clean vehicle credit, used clean vehicle credit, and qualified commercial clean vehicle credit, and that's for businesses. Now, these were some of the main tax changes that you're going to see effective 2025 as part of the passing of the One Big Beautiful Bill Act. However, there are many other changes that do take effect in 2025 and in the coming years. So talk with a qualified tax professional if you have any questions about how your personal tax situation might be effective. And be sure to follow our YouTube and Instagram channels to stay up to date on the latest financial news. As a reminder, this video is provided for educational purposes only, and it is not intended to provide advice specific to your situation.